Hi everyone, it's Paul Tilley and welcome back. Today we're looking at Unit 3, Measuring the Economy, Unemployment, and Inflation. This is going to be a two-part video. The first part, I'm going to look at unemployment, and the second part, I'm going to look at inflation. Both parts are covered in Chapter 4 of the textbook and Unit 3 of the course. Unit 3 has some key objectives. The first two deal with the first section, and the second two deal with the second section. We're going to look at explaining what inflation is, how it's measured, and we're going to explain the two types of inflation and describe the costs of inflation to the economy. Inflation, by definition, is the increase in the general level of prices sustained over a period, usually 1 year, in the economy. So we can use a couple of measures for measuring inflation. The most common one is something called the Consumer Price Index, or the CPI. And the second one that we use is called the GDP deflator, the Gross Domestic Product deflator. And we recall that the gross domestic product is the sum of the value of all goods and services produced in Canada for end users in a year. Now, measuring the inflation with the Consumer Price Index. How do we do it? Well, it's a measurement of the average level of prices of the goods and services that a typical Canadian family consumes. You could imagine it as a basket of items, like a basket of groceries in the grocery store. And what we do is we go in on a given year and we buy that basket of groceries. And it comes out, say, to $100. We go back in subsequent years and we buy exactly the same basket of groceries. And we ask ourselves, how much has the price gone up? So let's say, for example, in the first year we bought the groceries, it was $100. And in the second year, we bought the basket of items and it was $105. The difference between them is $5. That, by definition, would be the inflation rate, or a 5% increase. Now, that's simplified. The real Consumer Price Index calculation uses a basket, no doubt, but it's not just one item. It's not groceries. It's typical items that a consumer would buy. And in fact, what they've done in order to kind of whittle out this problem of potential issues with Consumer Price Index calculation and weird variations, they've taken out products that are widely variable, and groceries are one of those products. In order to calculate the CPI, we take the cost of the basket of items in a given year and compare it to the cost of the items in a base year. We call that year a base year. And the base year changes every once in a while, but generally you will be given the base year and you just compare your year to the base year, and that will give you the inflation over time, the amount of price rise over time. The inflation rate then is the year 2 minus year 1 divided by year 1. Effectively, how much did it rise in a percentage format? CPI, that basket, as I say, does not include things like fruits and vegetables, gas, fuel oil, mortgage interest, and tobacco, because those rates change a lot. We've seen during the pandemic, for example, that all of these prices of fruits, vegetables, gasoline, fuel oil, mortgage interest, and tobacco all went crazy. It was all over the place, usually higher. So that would have given you an artificially high inflation rate, a short-term inflation rate at that. So what Stats Canada try to do is to say, let's look for items that are more stable, and that way we get a better realistic picture of the long-term inflation rate. The second method that's used is GDP deflator. The GDP deflator is a measure of the level of prices of goods and services included in the gross domestic product. And again, it's all final goods and produced in Canada during the year. So the deflator is simply the nominal GDP divided by the real GDP. So there is a calculation every year of the nominal GDP. There's a calculation of the real GDP. We compare the two by dividing one by the other, and that will give us this GDP deflator inflation rate. So, comparing the two, then, the Consumer Price Index is an explicit index used and constructed of a bundle of goods. The bundle of goods contain standard items that are constant from one review to the next. It doesn't include capital or government goods or services, and it includes imports. The GDP deflator, on the other hand, is the explicit index measuring a ratio of nominal versus real GDP. The bundle of goods changes each year and includes capital and government goods and services, and it excludes import goods. So you can see slight variations too. Let's look at this concept of nominal and real. We've been beating around the concept of nominal and real here for a bit, and now we need really to explain how it works. So let's look at it from a nominal versus real income perspective. Nominal income is the present dollar value of your income. So if you make $100,000 a year, that is your nominal income. That is what's stated on your check. Real income, on the other hand, is the purchasing power of that income. Okay, so it is what that can buy. Inflation will affect how much you can buy. So in order to calculate the real value in a given year, we take the nominal value of an original year, divide it by the price index for the year, and that will give us the real value. We can see if we do a comparison of nominal versus real income here over the past 50 years. Movie tickets, for example, in 1958, they cost $1. In 2020, the real value, in other words, considering inflation, how much is $1 in 1958 worth today? It would be $9.74. The actual price of the ticket was $12. So yeah, the price of movie tickets have gone up. You know, if we factored out inflation, the price would be $9.74. It's $12. Let's look at a newspaper. A newspaper cost 7 cents in 1958. The real value of that 7 cents in 2020 was 63 cents. You can see newspapers are now charging $2.60 a copy. So you can see that, yeah, it's gone up quite a bit. Gasoline. Gasoline in 1958, it was 8 cents an liter, I assume. And the real value of it in 2020 was 72 cents. So, okay, 8 cents was worth 72 cents in 2020. And the real price of gasoline is $1.10, $1.30. So, yeah, it's gone up. Price of gas has gone up. Not by as much as what we think, though. Cigarettes, 25 cents in 58. That's worth $2.24 in 2020. There's actually charging somewhere between $10 and $13 for that. So that's gone a lot. If you recall syntaxes in our earlier microeconomics course, you understand that government can tax those very easily. And that's exactly what's happening. Let's take a look at test your understanding. Etruria's nominal GDP rose from $42 billion in 2019 to $45 billion in 2020. During the same period, its inflation rate was 5%. So what we're trying to do is tease out the inflation factor and how much that accounted for the change. So we're asking A, by what percentage did nominal GDP increase? And B, by what percentage did real GDP increase? So nominal GDP is really just counting raw numbers, okay? So if we look at the solution here, we take the 45, subtract the 42, divide it by the 42, and that will give us a 7.14% increase in GDP. And that's just nominal GDP. Looking at the numbers, went from 42 to 45, 7.14. Real GDP, on the other hand, we need to think about, okay, how much did it increase? Well, we're asking, what percentage did real GDP increase? Well, we know that the nominal percentage change in nominal income, we calculated it to be 7.14 or 7.2 rounded. We know inflation was 5%, so all we need to do then is take 7.2, subtract out the 5 of inflation, and that would say a real change of 2.2%. There's another important economic rule that we want to introduce here called the rule of 70. This has to do with doubling. Estimates are made of how often it takes for prices to double. And the rule of 70 is just used to do that. What we do is we take the rule of 70 and we figure out what the percentage growth rate is per year. We take 70 and we divide that percentage growth rate, and that will give you the number of years for something to double. So if you invest $1,000 at 10%, when will it double? Well, we take 70, divide it by the percentage, and that's 7 years. That's a pretty straightforward. So if inflation rate is 7%, how long will it take prices to double? Well, we got 70 divided by 7%, 10 years. So let's now turn our attention to the cost of inflation. What is the cost of inflation? Well, the cost of inflation can really be described in a few ways. First, we got something called redistributive cost. And what that does is it shifts income from economically weak to economically strong. In other words, effectively, it makes the rich richer and the poor poorer. and it shifts income from lenders to borrowers. Why exactly is that? Well, you think about it now. People with lots of money tends to be savers. People with little money tend to be borrowers. Inflation eats away at the value of their money, drives up interest rates, makes money more expensive, takes away poor people's money. The opposite is true for people who are saving. It tends to drive up interest rates, make more money in interest, and as a result, it makes the rich richer and the poor poorer. Another cost is something called the outcome costs. And what it does is it reduces the level of investment in economic growth because output costs become more expensive. It increases the basic costs or menu costs, such as the cost of revising catalogs, websites, and so forth, and it reduces people's willingness to spend that money. Effectively, the cost of building a house goes up. I'm not going to bother to build a house. And this effectively reduces economic growth in our economy, reduces exports, and increases imports because stuff is cheaper somewhere else, obviously, if inflation is not as high somewhere else. So it puts us in a poor position. When inflation goes really wild, really high, that's what's called galloping inflation. And government certainly does not want galloping inflation. Sometimes it's called hyperinflation is the terminology we hear. And that's when we have extremely high inflation. What that does is it erodes really quickly people's buying power. And it happened in Germany. We saw prices, going up thousands of percent every year. And it will eventually cause the economy to crash because nobody can afford anything. Now, if we look at, the real interest rate is the nominal rate minus our inflation rate. If we look at an example, test your understanding. If you're borrowed a sum of money for 1 year at a nominal rate of 11%, and during the same year the inflation rate was 4%, what's the real rate of interest did you pay? You're going to get a sum of money, and you're going to pay interest on it. That sum of money, though, gets devalued with inflation, right? So the net effect is that what you're paying back is not as valuable. So you're paying a high interest to rent the money. What you're paying back is not as valuable. So the net effect is the difference between the interest that you're paying and how much inflation is on it. Two of those net out, and hence your real rate of interest is a proportion of your nominal rate minus our inflation rate. What are some of the types of inflation that float out there? Well, there's something called demand pull inflation that's driven by consumers. When total demand for goods and services exceeds the economy's capacity to produce, and we saw that during COVID, we have more dollars chasing fewer goods, which drives up prices. That's what's called demand pull inflation. We also have cost push inflation. And that's caused by increases in cost of production or in profit levels or the effect of being on the supply side. It includes higher wages, for example. Companies paying higher wages or companies demanding higher profits or imports are driving up prices. And that really is a function of inflation that's caused by companies' costs going up. Usually demand pull and cost push inflation end up working at the same time. So that covers that section. I hope you have a better understanding now than when you started. Thanks for watching. Again, if you have any questions, let me know. Thanks.